Let's say you have plenty of money saved up and a friend wants to borrow some. You would probably consider whether or not they tend to pay people back before agreeing to help them out. This is similar to what banks and other institutions do. They check your borrowing and payment history before doing business with you. It helps mitigate the risk of not being paid back. Your borrowing and payment history is calculated into what's called a credit score, and there are three main institutions that keep track of it. These numbers have become an integral part of our lives. They determine whether you get loans and the interest rates you'll pay. Remember that interest refers to a percentage of the amount you're borrowing that's added to your debt. People with good credit scores tend to get lower interest rates. This is why understanding how credit scores are calculated will help you manage and improve your credit scores. While different lenders have different ways of calculating your credit score, it's crucial to ensure your credit history is in good standing with the main credit bureaus. They use a FICO model to get your score. This factors in details like your payment history, amounts owed, length of credit history, credit mix, and new credit. Payment history details how you've paid accounts over time. This considers whether you have made on time or late payments for things like utility bills, debt, or insurance. Payment history has the greatest impact because it accounts for 35% of your score. Amounts owed represents the amount of money you owe creditors, which we sometimes call your credit balance. Accounting for 30% of your credit score, it has the second greatest impact on your rating. If you have a high credit balance and you're making consistent payments, you'll not see a negative impact on your credit score. But a future creditor might be hesitant to issue additional credit to avoid having you default if you have a high credit card balance. Length of credit history is the overall time you've had credit accounts. This includes all open and active credit accounts. The longer your credit history of good payments, the better your credit score will be. But if you don't have a long history, it shouldn't hurt your score. Length of credit history accounts for 15% of your credit score. If you had previous accounts and paid and closed them, they will not be included in your credit history. Credit mix is the type of credit you have. This can include loans, credit cards, and mortgages, which are all different lines of credit. You don't need to have all these credit types to have a good credit score, but your ability to manage the different types impacts your score. New credit factors in how frequently you open new credit lines. You can negatively impact your credit score if you open too many credit lines in a short amount of time. Credit mix and new credit each account for 10% of your credit score. If you consistently make payments on time and limit the amount you owe, you'll find debt easier to manage. The length of your credit history, the types of credit you have, and how frequently you open new accounts also impact your financial health. Being responsible with how much debt and the kinds of debt you're taking on will help you improve and maintain a good credit score. To improve your credit score, consider how the five factors apply to your life and determine where you may need to make changes. To avoid falling behind on monthly payments, create a plan to at least make the minimum payment that will improve your credit score. It's important to manage the credit you have rather than opening new lines of credit. Lowering your credit card debt and creating consistent payment habits will be more impactful to your overall credit health. If you have a low credit score, it will be difficult for you to get new lines of credit and secure lower interest rates. This is because creditors will see you as a greater risk of defaulting. If you do manage to get a new line of credit with a low score, you may find that your interest rate is higher. Creditors set higher rates to mitigate the risk of lending to someone with a weaker credit history. The more you understand how your credit score is determined, the more likely you'll be able to remain in good standing financially.